Hey, what's up, class? CIS 3367. My final project will be based on company Aurora Cannabis Company. Ticker is ACB, Alpha, Charlie, Beta. And there's a lot of great news that's been associated with this company in recent days. First off, the company reported great quarterly earnings. It significantly reduced its costs while significantly increasing its sales. And then also the company just purchased a CBD United States based company called Reliva. So pretty much Aurora Cannabis was primarily only associated with Canada. However, now it also has markets in the United States, which is excellent. A lot of great news. The stock is hot right now. This is something that you definitely want to be in my own personal opinion. So let's just take a look at it. Alright, so let's just take a quick look at the 2-year chart, May 2018 to May 2020. And as you can see here, the stock has not done well in the long term. Matter of fact, I would never suggest even myself buying this thing for the long run. There's been a lot of empty promises and a lot of unfulfilled promises that ACB has made to its investors, such as being profitable by 2021. Not going to happen. Also, right, there was a reverse split. So the reason why the company of ACB did this was just to make the stock price more appealing to investors. And the reason why I want to bring up this chart was just to show the huge amounts of volume spikes. Every time this stock has a huge amount of volume spike, meaning that the number of shares traded within the trading day is significantly higher compared to the rest of the trading days, the stock tends to make a big move, just as expected. The last time it did have a significant spike in volume, it went from 45 all the way down to 28. However, this time it's taking a turn for the uptrend, right? And it's actually jumped from $6 all the way to $20 in the last 2 weeks, which is huge. Today it actually closed around $17. And let's just take a closer look at the year-to-date chart going forward. Alright, so now let's take a closer look at the year-to-date chart. As I've said before, huge amounts of volume spike in recent weeks, sending this stock from nearly $5.8, all the way to $20 back around, just a few days ago. So I do think, knowing this, was including the news and the great quarterly earnings, short term, definitely a stock I want to be in, and definitely a stock I want to play in my own personal portfolio. So how do I play this? Well, yeah, I could buy the stock, okay, and I may buy it around $20, and I'm thinking that I probably will end up taking profit around $26. Wow, big whoop, $6 per share. That's not something that I'm trying to make. I'm a risk taker. I want to make a lot of money, especially with small amounts of point moves in a stock. So what I like to play is options. Now going forward, I'm going to give you 3 types of situations, 3 investment option strategies based on an investor's risk tolerance, and I will show you that going forward. Okay, so first and foremost, for all you new investors out there, what is a contract? A contract is the right to own 100 shares at a certain price upon expiration. This video has to be within 10 minutes, so I'm not going to go into detail about it, but I will explain 3 different option strategies based on an investor's tolerance, risk tolerance. So the first strategy that I did formulate myself based on my own personal trading experiences is going to include a call debit spread for stock ACB. So what is a call debit spread? Call debit spread is pretty much you're buying one call and then you're also selling a call, right, with a higher strike price, okay, relatively within the same expiration date or sometimes sooner than your long call expiration date. So the calls that I chose to buy were the $11 calls expiring January 15, 2021, currently trading at $6.20. Keep in mind that's $620 since you have the right to purchase 100 shares at that price. And we're going to be selling a call on top of our long calls, right? We're going to be selling the $37 calls expiring January 15, 2021. Those are currently trading at a price of $1.45, so $145. The cost of this trade, since you're buying this one at $6.20, you're selling that one at $1.45. The cost of this trade is around $475. Now, the idea upon this trade strategy is that you want the stock upon this expiration date to be between $11 and $37. Therefore, you collect the premium here while you also gain premium on your long calls. Okay, so now as we take a look at our call debit spread, right, graph, which is right here, we can see that anytime the stock trades above 1850, whether it's in May of 2020, which is this month, or January 2021, we make money. Okay, we make money, and the longer we go, and as long as the stock's trading above 1850, we make more money. Okay, and that's because we're also selling this call. We're selling this call to reduce our risk significantly. Okay, so pretty much by selling this call, we can only lose the cost of the trade, which is $475, rather than just buying this call and your downside is losing $620 if the stock doesn't close above $11 upon expiration date. Right, we sold this call to reduce our risk. Now, as you can see here, anytime the stock trades above 1850, we're making money. Great. Anytime the stock trades relatively around less than $16, we're going to be losing a lot. Okay, so the idea between this is that we want to have the stock close upon expiration date between $11 and $37. Alright, so now let's look at option strategy 2, which I'm assessing as fair risk. And as you can clearly see here, compared to the other option strategy, which is less risk, right, there's less chances that we'll make profit here. However, your profit is significantly higher if you are profitable compared to option strategy 1. And the reason that it is significantly harder to make profit is because we aren't selling any calls. We're actually just buying one long-term call, and we're buying the $18 calls expiring January 15, 2021. The current price for these contracts are $3.65. Therefore, your total cost of the trade is $365. Okay, so now if you take a look at this conditionally formatted table, right, you can see that if the stock goes higher relatively sooner, we make a lot more money compared to if it goes higher relatively longer in the long run. Okay, so if the stock closes around $28, right, within this month of May, we're going to be making $810 on our $365. But if the stock closes on January 2021 around $28, then we're only going to be making $635. And as many investors know, options are risky. Therefore, to be in the red is significantly higher than option strategy number 1, because we aren't selling calls here. Therefore, anytime the stock closes around $17, $17.50 in the next 3 months, we should be concerned. Okay, and every month that we wait while we're holding these contracts, our options actually have to go higher, or the stock actually has to go higher, right? Therefore, our contracts go higher. And I'm not going to get into the Greeks of options right now, but just know that the longer we wait and hold these contracts, the more money we're going to be losing in the long run. Alright, so let's just dive right into option strategy number 3. I'm assessing this as the most risky option strategy, and I'll tell you why. Okay, this option strategy, we're going to be buying September 28th, 2020, $25 calls. The current price, $1.92 per contract. Therefore, the cost of the trade is $192. The reason why you have less chances of being successful, as you can see in this conditionally formatted table, is because we're thinking as an investor that this stock will take a huge move upwards relatively quickly. I mean, based on a $192 trade, if you buy it now, which stock's trading around $17, and let's just say the stock opens up at $28 on the 22nd of May, which is tomorrow, or even the 27th of May, which is next Friday, we're going to be making $500 to $600, okay, on just a $192 investment really quick. That's huge. But the longer you wait, okay, the more profit you're going to be losing. And this is actually higher. Your chances of success are actually relatively lower than all the other option strategies. However, your profit to investment ratio is significantly higher if this if the stock takes a huge move upwards compared to all the other option strategy.